They keep telling you silver is plentiful, that any rally is just hype, and that the futures price you see on your screen is the real story. But here's the hidden truth. The danger isn't that silver has vanished. The danger is that silver has been pushed into the wrong places, and that single detail is how markets break. London is where the benchmark price is set. That's where big players source metal to meet immediate demand. And Goldman is warning that London inventories have become unusually thin because metal was pulled into U.S. vaults during tariff fears, leaving the benchmark hub vulnerable to squeezes. When flows hit London now, rallies can accelerate, then reverse violently when tightness eases. Goldman even estimates the market's sensitivity to demand has surged. What used to move silver around 2% can now move it closer to 7%. The same shove now creates a much bigger fall, or a much bigger surge. And this isn't theory. As of end December 2025, London vaults held 27,818 tons of silver, a big number that hides a reality. Not all of it is available when everyone reaches for the same door at once. So ask yourself, what happens when the market discovers the silver it needs isn't where the price is set? Most people hear silver volatility and shrug. They think it's just another commodity acting wild, a trade for gamblers, a chart for day traders. That belief is exactly what makes this moment dangerous. Because silver isn't just a shiny metal. It's a monetary asset, an industrial input, and a strategic material that sits inside the plumbing of modern life, from electronics to energy infrastructure. When the silver market gets distorted, you don't just get a price spike. You get a stress test of the entire system that depends on smooth delivery and trusted pricing. Here's the stake. The global benchmark price is supposed to represent a deep, liquid shared pool. One price, one market, one set of assumptions. But the wrong places problem is what happens right before a market stops acting like a pool and starts acting like separate puddles. Goldman's warning is blunt. If policy uncertainty keeps metal stranded in U.S. vaults while London stays thin, the market becomes squeeze-prone. Extreme moves in both directions. And if China's new requirement for official approval on outbound shipments tightens global movement, liquidity can fragment even further. Now layer in a near-term accelerant that almost nobody outside the professional world watches: commodity index rebalancing. In early January 2026, funds that track major commodity indices have to mechanically rebalance, and estimates suggest billions of dollars of gold and silver selling concentrated into a short window. That's not investor opinion. That's forced flow. Think about what that means. A market already prone to squeezes gets hit with algorithmic selling. Prices can dip hard. Headlines will scream bubble popping, and the average viewer will relax, thinking the danger passed. But forced selling doesn't fix a location mismatch. It doesn't refill the benchmark hub. It just shakes out weak hands while the structural stress remains. That's how every great wealth transfer begins: confusion first, then sudden repricing. And in markets, structural stress is the kind of thing that stays quiet, right up until the day it doesn't. If you want to understand what silver can do next, you have to stop thinking of it like a normal market. Silver doesn't crawl, it snaps. Look back at the 1970s. Inflation didn't feel like a single event. It felt like a slow leak that turned into a flood. By the summer of 1980, U.S. inflation was near 14.5%, and unemployment was over 7.5%, a toxic mix that crushed purchasing power and confidence at the same time. When people lose faith in money, they rush toward what feels real. That's when silver stops behaving politely. In January 1980, silver didn't just rise, it surged to an all-time nominal high of about $4,945 per ounce. It wasn't only demand, it was structure, concentrated buying, heavy leverage, and a market that suddenly realized deliverable supply was tighter than the paper claim suggested. Then came the part nobody celebrates when they post the chart. On March 27th, 1980, Silver Thursday, the price collapsed as margin calls hit and the attempt to control the market unraveled. By April 1st, silver had fallen from around $21.25 to about $10.80 in a matter of days. Fast forward to 2008, and you see the same anatomy. In the worst panic, silver dropped to around $9 as investors dumped anything liquid to raise cash. Then the pendulum swung the other way. After years of post-crisis money printing and speculative fever, silver surged again, hitting a record around $49.51 on April 28th of 2011. That is the pattern. Violent upside, violent downside, triggered by plumbing, not comfort story headlines. Silver is the metal where tiny imbalances become earthquakes, because the tradable float is thinner and the leverage is higher. When positioning is crowded, the market doesn't negotiate. It whipsaws fast, ruthless, and unforgettable for everyone. And the wealth transfer lesson is brutal. The winners aren't the loudest bulls. The winners are the ones who understand the mechanics, keep liquidity, and refuse to get forced out at the worst possible moment. Because in every real crisis, it isn't value that matters first. It's access. It's location. It's who can deliver and who can't. Now, let's pull the curtain back on what wrong places actually means, because this is the part most headlines never explain. Silver's benchmark price is still heavily influenced by the London market. London is where a huge share of wholesale trading, clearing, and short-term physical sourcing happens. When a refiner, fabricator, ETF, or bullion bank needs metal quickly, London is the door they reach for first. That's why tightness there matters more than a big headline number somewhere else. Goldman's warning is simple but explosive. During 2025, fear around tariffs and policy shocks encouraged large inflows of metal into U.S. vaulting systems tied to futures delivery. The metal didn't disappear, it moved. And when the benchmark hub is thin, while another region is heavy, the market becomes squeeze-prone. Here's the mechanism. Futures markets can create huge paper exposure relative to the amount of readily deliverable metal. Most contracts never demand delivery. They roll, net, or cash settle. But if even a small percentage suddenly insists on physical, the system has to locate bars fast, often by pulling from London inventories, leasing metal, or incentivizing shipments across oceans. That's where volatility is born. A location mismatch turns a normal bid into a panic bid. Lease rates can jump, spreads can widen, and the price can gap higher as traders scramble for deliverable supply. Then, when the bottleneck eases, one large shipment arrives, one big buyer steps back. The same market can collapse just as fast. That up and down violence is exactly what Goldman is highlighting. And the stats can look comforting while the float is still tight. LBMA's end December 2025 report shows London silver holdings at 27,818 tons. But held doesn't automatically mean available at the margin. Some is earmarked, some is in the wrong form, some is not willing to move at today's price. Meanwhile, the COMEX warehouse reports track registered versus eligible stocks, another clue about what is actually deliverable into contracts. So the real question isn't, is there silver? It's how much can move fast to where the price is set without breaking the market. And that's the trap. Now we add the spark that can turn a tight market into a fractured one. Policy friction. When a commodity is freely mobile, arbitrage keeps prices honest. If silver is $1 cheaper in one hub, traders move metal, the gap closes, and the market stays one market. But when shipping becomes uncertain tariff threats, export approvals, extra paperwork, sudden restrictions, the system stops behaving like one pool. It starts behaving like regions with their own rules, their own premiums, and their own panic. That's why the China angle matters in 2026, even if you never buy a single ounce. If outbound shipments require official approval, or if companies expect approvals to be delayed, they don't wait. They front run. They stockpile quietly. And once stockpiling begins, it becomes self-reinforcing. Tighter availability leads to higher local premiums. Higher premiums attract more hoarding, and hoarding reduces the metal willing to move back into the global stream. Here's the ugly part. A fragmented silver market can create multi-price reality. One price on a screen in New York, another in London for immediate delivery, another in Asia where fabrication demand is concentrated. And the more those prices diverge, the more faith gets shaken in the paper benchmark. Not because paper is fake, but because paper is designed for liquidity, while real industry runs on deliverability. This is how a quiet breakdown forms. Not with a headline saying shortage, but with spreads that refuse to close and premiums that stop behaving. And once participants learn that location is destiny, behavior changes fast. Traders become less willing to short into tightness. Fabricators buy earlier than they need. Banks demand more collateral. Exchanges adjust margins. Liquidity thins. Volatility rises. And the average investor, who thought silver was boring, suddenly meets a market that can move like a meme stock. Only, this time, the driver isn't social media. It's logistics, policy, and fear. So when you hear wrong places, don't picture a warehouse map. Picture a market where the bridges between regions start to crack, and where a single surprise announcement can turn normal delivery into a scramble. Here's where most people get misled. They think paper versus physical is some internet conspiracy. It isn't. It's simply how modern commodity markets work, until stress exposes the weak points. A futures contract is a promise tied to a reference price. It's built for speed, leverage, and liquidity. Most of the time, that's fine, because contracts get closed or rolled long before delivery. But in a tight market, the gap between tradable exposure and deliverable metal becomes the whole story. That's why the warehouse categories matter. Eligible metal can meet standards, but it isn't necessarily committed for delivery. Registered is the category that can be delivered against contracts. When registered stocks get thin, the market can still look calm, right, up until a few big players decide they want bars, not cash. Then you get the domino effect. Dealers raise premiums, fabricators pre-order, custodians face tougher sourcing, spreads widen between immediate delivery and future delivery, and suddenly the headline price stops telling you what it actually costs to get silver into your hands or into a factory line on time. This is the wrong places problem in simple terms. Silver can exist on paper or in vaults, yet still be hard to access where demand is pressing right now. And when that happens, the market's psychology flips. People who never cared about deliveries start caring. Traders who always assumed they could exit discover the exit is crowded. And the most dangerous illusion appears that the screen price is the price. In reality, under stress, the price becomes a range. The futures price, the spot price, the local premium, the shipping cost, the delivery timeline, the trust factor. That's why quiet breakdown is the correct phrase. It's not one cinematic collapse. It's a slow separation between what the benchmark says and what the physical world demands until the separation becomes too obvious to ignore. And once it becomes obvious, the repricing doesn't come gently. It comes in gaps up, down, and back again because the market is no longer balancing supply and demand. It's balancing fear and access in real time. So what do you watch if you want to spot the breakdown before it becomes a headline? Not the loudest influencer, not the flashiest chart. You watch the plumbing. First, you track inventories, especially the categories that represent deliverable supply. CME publishes daily warehouse stocks for silver, and those reports show how metal is classified and where it sits. If registered supply trends lower while prices rise, that's not just bullish. It's a warning that demand is pressing on the deliverable edge. Second, you watch spreads that hint at stress. When the market is relaxed, the relationship between near-term and longer-term pricing stays orderly. When the market is stressed, those relationships start to misbehave. Premiums and differentials widen, and the bridge between paper and physical becomes expensive. Third, you watch the behavior around delivery months. Most players roll. But when more players stand for delivery, the market has to locate metal. That's when you see sudden spikes in volatility and margin changes. On forums and trader communities, people track these stress moments obsessively because they often appear before any mainstream story. Fourth, you watch headlines that look unrelated. Because in commodity markets, forced flows can hide the real signal. Commodity index rebalancing, for example, can create mechanical selling in a short window, even if fundamentals are tight. Financial Times highlighted that index changes could trigger waves of bullion selling into early January 2026. That kind of selling can produce a sharp dip, exactly the type that convinces the public the panic is over. But forced selling doesn't solve a location mismatch. It simply transfers risk from weak hands to strong hands. And finally, you watch language shifts from institutions. When a major bank says the market is vulnerable to extreme price swings because silver may stay stuck in the wrong places, that's not entertainment. That's a signal that professionals are focusing on mechanics, not narratives. Put all of this together and you get a simple rule. The breakdown doesn't announce itself with one giant crash. It announces itself with small, stubborn signs that stop going away inventory pressure, widening differentials, volatile delivery cycles, and official commentary that quietly admits the market is becoming harder to balance. That's when you know you're not watching a normal bull market. You're watching a system strain. Now, let's talk about the part nobody wants to hear, because it forces you to admit how fragile normal investing assumptions really are. When markets break, the first people who get hurt are not the beginners. It's the people who are certain the system will behave the way it always has. In a silver dislocation, the biggest losers are usually the leveraged and the complacent. Traders who assume liquidity will always be there. Funds that treat metals as just another allocation, and investors who chase after a parabolic move because they think this time it's different. Because silver doesn't punish ignorance, it punishes timing. Imagine a squeeze forms in the benchmark hub. Prices spike. News spreads. Social media explodes. People who ignored silver for years suddenly feel the fear of missing out. That's when the trap is set. They buy late. They buy with leverage. They buy right as premiums widen and volatility is peaking. Then the market does what silver always does. It snaps back. One policy headline changes. One shipment arrives. One forced selling wave hits. And the same people who rushed in are forced out at the worst moment. Not because they were wrong about the long-term story. Because they ran out of oxygen. That is how wealth gets transferred. Not from poor to rich. From the impatient to the prepared. And who benefits? The players who understand the cycle and keep optionality. The ones holding liquidity when others are margin called. The ones who don't need to sell into a dip. The ones who can wait. Because in a fragmented market, the greatest asset isn't prediction. It's staying power. Here's the bigger truth. In a real dislocation, markets reward discipline more than bravery. You'll see it in how institutions behave. When volatility rises, they don't chase. They scale. They hedge. They tighten risk. They wait for the forced sellers to create price windows. And the public misreads that calm as no danger. But calm is exactly what smart money looks like when it's preparing. So if 2026 becomes a year where silver is repeatedly trapped in the wrong places, where squeezes and reversals become the new normal, then the most important decision won't be bullish or bearish. It will be, will you be forced to act at the worst time? Or will you still have choices when everyone else has none? Here's where this story gets twisted in a way most people never see coming. The market can scream crisis and still give you a window. In fact, the most profitable windows often arrive disguised as disappointment. Remember the forced flow catalyst we talked about? Commodity index rebalancing. When large index funds rebalance, they don't decide to sell because fundamentals changed. They sell because the rules say they must. Financial Times flagged that index changes could trigger a concentrated wave of bullion selling into early January 2026. That's important because in a market with structural stress, forced selling can create what looks like a collapse, but is actually a transfer. Prices drop. Commentators declare the rally dead. Viewers breathe again, and that is exactly when positioning quietly changes hands. You've seen this movie before? In 2008, silver didn't collapse because it had no value. It collapsed because the world was desperate for cash. The panic created the greatest buying windows of a generation. If you had liquidity and the nerves to act when everyone else wanted safety. The same principle applies here, but with a modern twist. The breakdown isn't just macro panic, it's plumbing pressure. If silver is stuck in the wrong places, a dip caused by forced selling doesn't fix the mismatch. It doesn't magically refill London. It doesn't remove policy friction. It simply compresses price temporarily while the structural tension remains. That's why these dips are so psychologically violent. They shake out the people who bought the story but didn't understand the mechanism. And once they're shaken out, the market becomes even more unstable because the remaining participants are stronger hands and smarter hedgers, people who will push harder when stress returns. This is also where the crowd gets tricked by the wrong scoreboard. They see the futures price drop and assume silver is available again. But availability is not just price. It's time, location, and willingness to deliver. When those factors are strained, the repricing doesn't happen smoothly. It happens in bursts. So the opportunity moment in this narrative isn't a fantasy that silver only goes up. It's the reality that a fractured market produces repeated, window-sharp dips, sharp spikes, and mispriced fear, where preparation matters more than prediction. Because the biggest money is rarely made by being right once. It's made by being ready when the market offers a gift wrapped in panic. Now, let's pivot, because this is where most finance channels either get reckless or get useless. You don't need a prophecy, you need a framework. Because if 2026 becomes the year silver keeps snapping between tight and relieved, the worst mistake is thinking there's one perfect move. In a volatile market, the real advantage is staying rational while everyone else is emotional. So what does that look like without giving direct financial advice? First, understand what you actually own. If your exposure is paper-based, your risk is primarily price volatility and liquidity conditions. If your exposure is physical, your risk includes premiums, storage, and the practical reality that physical markets can behave differently than screens. The point is not that one is good and the other is bad. The point is that they behave differently when stress hits. Second, respect the possibility of multiple prices. When markets fragment, you can see a futures benchmark, a local cash price, and a real-world availability premium at the same time. That doesn't automatically mean manipulation. It often means friction. The more friction, the more violently markets reprice. Third, keep liquidity and avoid forced decisions. The people who lose wealth in crises are usually the ones who have to act because they use too much leverage, or they chased too late, or they didn't plan for volatility. In every historical shock, the winners were not the loudest. They were the ones who had the ability to wait and the discipline to act when value appeared. Fourth, stop outsourcing your thinking to headlines. In a dislocation, the headline will always arrive late. By the time mainstream media says silver is in trouble, the easy move is gone, the job isn't to react faster. The job is to watch the indicators that move before the story. Inventories, spreads, delivery pressure, policy friction, forced flows. And finally, don't confuse excitement with signal. When retail sentiment hits euphoria, risk rises. When sentiment flips to despair during a mechanical sell-off, opportunity often rises. That's the wealth transfer pattern repeated across 1929, across the 1970s, across 2000, across 2008. The crowd sells certainty, and the prepared buy optionality. If this wrong places thesis is correct, you're looking at a market that may not blow up once. It may stress, snap, and reset again and again, training the public to stop paying attention, right before the real repricing happens. So the real question isn't, will silver go up? It's, when the market offers panic price decisions, will you be thinking like the crowd, or like the people who win after every crisis? So here we are, early 2026, and the market is still pretending silver is just a sideshow, a speculative metal, a trade you dabble in. But the professionals are watching something else. The plumbing. A benchmark hub that can go tight fast. Metal that can't always move where it's needed. And a system that becomes unstable when inventory exists, but deliverable inventory is thin. That's why the story matters, even if you never touch a futures contract. Because when price discovery breaks, it doesn't stay contained. It spills into confidence, into cost, into the psychology of risk. Goldman's warning about extreme price swings is not a promise that silver only goes up. It's a warning that the market can lurch higher, lower, then higher again, because the metal may remain stuck in the wrong places. And when forced flows hit, like the index-related bullion selling window flagged by the Financial Times, those lurches can look like the story is over, right before the underlying stress returns. This is how quiet breakdowns happen, not with one dramatic collapse, but with repeated episodes that train people to ignore the signal. A spike, a crash, a recovery, a shrug. Until one day the market reaches for metal, and the metal is not where the price is set. So what should you do with that knowledge? You don't need panic, you need awareness. Watch the official vault reports. LBMA's London holdings and CME's warehouse classifications are not clickbait, they're the scoreboard of availability. Watch the spreads and delivery months for signs the bridge is straining. And watch your own behavior, because the easiest way to lose in silver is to be right about the story and wrong about the timing. Because when this market snaps, it won't give you a polite warning. It will gap. And the move happens before headlines, before experts, before the crowd even notices. So I'll leave you with one final question. When the market finally admits silver is in the wrong places, will you be one of the forced sellers or one of the people who saw it coming?